The year 2008. A year etched in the memory of many as a time of profound financial turmoil. It was a year when the world witnessed the fragility of the financial systems we had come to rely on. The crisis didn't just affect Wall Street. It rippled through main streets across the globe, impacting everyday lives in ways that were previously unimaginable. The world watched, stunned, as the global financial system teetered on the brink of collapse. Banks that were once considered too big to fail were suddenly on the verge of bankruptcy, and governments scrambled to prevent a total economic meltdown. It was a period of intense uncertainty, fear, and economic pain. People lost their jobs, their homes, and their savings. The sense of security that many had taken for granted was shattered, leaving a lasting impact on the collective psyche. The crisis exposed vulnerabilities in the global financial architecture, raising profound questions about risk, regulation, and the role of government. It became clear that the systems in place were not equipped to handle such a massive shock, and that significant changes were needed to prevent future crises. More than a decade has passed since the global financial crisis of 2007 to 2008 sent shockwaves through the world economy. While some economies have recovered, others are still grappling with the long-term effects. Yet its scars remain, serving as a stark reminder of the devastating consequences of financial instability. The crisis left a trail of foreclosed homes, shuttered businesses, and shattered dreams in its wake. We are left grappling with its legacy, questioning how we could have let this happen and what lessons we have learned. The crisis forced us to reevaluate our understanding of financial markets and the importance of robust regulatory frameworks. This essay delves into the aftermath of the crisis, examining its profound and lasting impacts on our lives, our economies, and our world. It looks at how the crisis reshaped the financial landscape and the measures taken to rebuild and strengthen it. It explores the human cost of the recession, the unprecedented policy responses it triggered, and the regulatory reforms implemented to prevent a repeat of such a catastrophic event. The human stories behind the statistics reveal the true cost of the crisis. Ultimately, we must ask ourselves, are we better prepared for future financial crises? Have the reforms and safeguards put in place been enough to protect us from another financial disaster? Have we learned from the mistakes of the past, or are we doomed to repeat them? The answers to these questions will determine the resilience of our financial systems in the face of future challenges. The answers to these questions are crucial for ensuring a more stable and resilient global financial system. As we move forward, it is imperative that we remain vigilant, learn from our past, and continue to adapt to an ever-changing financial landscape. Behind the cold statistics and complex financial jargon lies a deeply human story. The global financial crisis was not just an economic crisis, it was a human crisis. It was a story of lost jobs, foreclosed homes, and shattered dreams. Across the globe, millions of people were thrown into unemployment lines as businesses closed their doors and economies contracted. In the United States alone, the unemployment rate soared to 10%, a level not seen since the early 1980s. Families struggled to make ends meet, and the American dream seemed to slip further out of reach for many. The housing market, once a symbol of prosperity, became the epicenter of the crisis. Millions of homeowners, many of whom had taken on subprime mortgages they could not afford, faced foreclosure. Families were forced out of their homes, displaced and left with a sense of despair and uncertainty about the future. The crisis exposed the deep inequalities that existed within societies, disproportionately impacting the most vulnerable. Low-income households, communities of color, and developing countries bore the brunt of the economic downturn, exacerbating existing social and economic disparities. The human cost of the crisis serves as a stark reminder that economic crises are not just abstract events. They have real and devastating consequences for real people. Faced with the worst financial crisis since the Great Depression, governments and central banks around the world took unprecedented measures to stabilize their economies and prevent a complete meltdown of the global financial system. The crisis, which began in the financial sector, quickly spread to the broader economy, leading to massive job losses, plummeting stock markets, and a severe contraction in economic activity. The urgency of the situation required swift and decisive action from policymakers. They injected trillions of dollars into the financial system, slashed interest rates, and launched massive stimulus packages to boost demand and create jobs. These measures were aimed at restoring confidence in the financial markets and ensuring that businesses and consumers had access to the credit they needed to keep the economy moving. The scale of the intervention was unprecedented, reflecting the severity of the crisis and the determination of policymakers to avoid a repeat of the Great Depression. In the United States, the American Recovery and Reinvestment Act of 2009, commonly known as the stimulus package, pumped $831 billion into the economy through a combination of tax cuts, infrastructure spending, and aid to state and local governments. This comprehensive approach was designed to address both the immediate need for economic stimulus and the longer-term goal of rebuilding the nation's infrastructure. The package included funding for a wide range of projects, from road construction to renewable energy initiatives, aimed at creating jobs and laying the foundation for future growth. The Federal Reserve, the U.S. central bank, implemented a series of unconventional monetary policies, including quantitative easing, to lower long-term interest rates and encourage lending. By purchasing large quantities of government securities and other financial assets, the Fed aimed to inject liquidity into the financial system and support economic activity. These measures were complemented by forward guidance, where the Fed communicated its intentions to keep interest rates low for an extended period, providing additional reassurance to markets and investors. Internationally, there was an unprecedented level of cooperation and coordination among countries. Recognizing that the crisis was global in nature, governments and central banks worked together to implement synchronized policy responses. This included coordinated interest rate cuts, joint financial support for struggling economies, and collaborative efforts to stabilize the global financial system. The spirit of international solidarity was crucial in preventing the crisis from spiraling out of control. The Group of 20, a forum of the world's largest economies, emerged as the leading platform for coordinating global economic policy responses. The G20 meetings provided a venue for leaders to discuss the challenges they faced and to agree on collective actions to address them. The group's coordinated efforts included measures to support global trade, enhance financial regulation, and provide financial assistance to countries in need. The G20's role in the crisis underscored the importance of multilateral cooperation in addressing global economic challenges. The International Monetary Fund played a crucial role in providing financial assistance to countries hit hard by the crisis, particularly in Europe. The IMF's support helped to stabilize economies that were facing severe financial difficulties, preventing defaults, and restoring confidence in the global financial system. The fund's involvement also included technical assistance and policy advice, helping countries to implement necessary reforms and to navigate the complex challenges posed by the crisis. While these measures were successful in averting a complete financial collapse, they came at a cost. Government debt levels soared as a result of the massive stimulus spending, raising concerns about fiscal sustainability and the long-term health of public finances. The unconventional monetary policies also had significant implications, including potential risks to financial stability and the challenge of unwinding these measures without disrupting the economic recovery. The debate over the long-term consequences of these policies continues to this day. Government debt levels soared as a result of the massive stimulus spending, and the long-term consequences of the unconventional monetary policies remain a subject of debate among economists. Some argue that the policies were necessary to prevent a deeper crisis, while others caution that they may have created new risks and vulnerabilities in the financial system. The experience of the crisis has led to ongoing discussions about the appropriate role of government and central banks in managing economic stability. However, the swift and coordinated global response undoubtedly helped to mitigate the severity of the crisis and set the stage for economic recovery. The actions taken by governments and central banks around the world demonstrated the importance of decisive and collaborative leadership in times of crisis. As economies began to recover, the focus shifted to ensuring sustainable growth and addressing the structural issues that had contributed to the crisis. The lessons learned from this period continue to inform economic policy and crisis management strategies today. In the wake of the financial crisis, there was widespread recognition that the existing regulatory framework had failed to prevent excessive risk-taking and protect consumers. The crisis exposed significant weaknesses in the financial system, leading to a loss of confidence among investors and the public. The repercussions were felt globally, with economies around the world experiencing severe downturns. This led to a wave of regulatory reforms aimed at strengthening the financial system and preventing a repeat of the crisis. Lawmakers and regulators worked tirelessly to draft new rules and regulations that would address the vulnerabilities exposed by the crisis. These efforts were driven by a desire to restore stability and trust in the financial markets. In the United States, the most significant piece of legislation to emerge from the crisis was the Dodd-Frank Wall Street Reform and Consumer Protection Act, commonly known as the Dodd-Frank Act. This comprehensive legislation aimed to overhaul the financial regulatory framework and address the root causes of the crisis. Signed into law by President Barack Obama in 2010, Dodd-Frank represented the most comprehensive overhaul of financial regulation since the Great Depression. The act introduced a wide range of measures designed to increase transparency, accountability, and oversight within the financial system. The Dodd-Frank Act aimed to address the root causes of the crisis by enhancing systemic risk oversight, increasing capital and liquidity requirements, regulating derivatives, and protecting consumers. It sought to create a more resilient financial system that could better withstand future shocks and crises. The act established the Financial Stability Oversight Council to identify and respond to systemic risks posed by large, interconnected financial institutions. This council was tasked with monitoring the health of the financial system and taking action to mitigate potential threats. Banks were required to hold more capital and liquid assets to better withstand financial shocks. These measures were intended to ensure that banks had sufficient resources to absorb losses and continue operating during periods of financial stress. The act brought over-the-counter derivatives under regulatory oversight, requiring them to be traded on exchanges or through clearinghouses. This move aimed to increase transparency and reduce the risks associated with these complex financial instruments. The Consumer Financial Protection Bureau was created to protect consumers from unfair, deceptive, or abusive practices in the financial industry. This new agency was given broad powers to oversee and enforce consumer protection laws. The Dodd-Frank Act was a landmark piece of legislation that significantly reshaped the financial industry in the United States. Its impact was felt across the financial sector, from large banks to small community institutions. Its provisions, while complex and sometimes controversial, were designed to promote financial stability, protect consumers, and prevent future crises. The Act's legacy continues to influence financial regulation and policy debates to this day as stakeholders assess its effectiveness and consider further reforms.